All right, welcome to Talk Tickers. Today, we're unpacking BioHarvest's Q2 2025 earnings. Look, the press release gives you the numbers, sure, but the real story, that came out on the analyst call. And trust me, it's one you're going to want to hear. So, how did the market react? Well, it was meh. A tiny pop, then it closed almost flat. And that right there tells you the whole story. What we have is a classic tug-of-war. Awesome top-line growth on one side, but a miss on the bottom line on the other. You can almost hear the market whispering, okay, prove it to us.
Okay, so let's get into the nitty-gritty. This quarter was a real mixed bag.
First up, the part that's raising some eyebrows. Wall Street was expecting a loss of about 11 cents a share. BioHarvest came in at a loss of 15 cents. That's a 4-cent miss. And, for a company that's all about that march to profitability, any miss on earnings gets put under a microscope, for sure.
But wait, that EPS miss? It's really only half the picture, because when you look at the top line, wow, the company pulled in $8.5 million in revenue.
And here's where things get really interesting. That's a 41% jump from the same time last year. Let me say that again, 41%. This isn't some small incremental bump. We're talking about serious, rapid expansion. It's proof positive that people want what they're selling.
And get this, it's not just empty growth, it's becoming more profitable growth. They hit a 60% gross margin, which by itself is pretty solid. But the real story here is the improvement. That's an 800 basis point jump from last year. What does that mean? It means for every dollar of sales, they're getting way more efficient. And that is a huge, huge lever when you're trying to hit profitability.
So you might be asking, how are they pulling this off, growing so fast, and improving margins? Well, it all comes down to their two-pronged or dual-engine strategy. You've got their consumer products, and then you have a whole other way they're making money from their core tech.
Let's look at the product side first. Where's the new revenue coming from? Well, about 20% of that new growth is from new products, but the original VINIA capsules, they're still the absolute workhorse, driving the other 80%. And that's actually a really healthy mix, right? You've got your reliable engine, and you're adding these new, exciting boosters on top.
Okay, now for engine number 2, the CDMO business. And if you're not familiar with that term, don't worry. A CDMO is basically a high-tech lab for hire. Other pharma and biotech companies pay them to develop and manufacture stuff. So BioHarvest is taking its super unique platform and essentially renting it out to help other companies create these really valuable compounds.
And the way they do it is really smart. It's a step-by-step process. First, they have this new AI service that helps discover potential compounds, and they get paid for that. If they find something promising, boom, it moves to a stage 1 contract to see if it's feasible. They get paid for that too. And if that works, it moves to the big leagues, a stage 2 development deal. The key thing here is they're getting paid at every single step, which lowers their risk and proves their tech works.
And this isn't just a theory, they're actually making real progress. This quarter, their very first pharma project moved up to stage 2. That's a massive win. They also signed this really cool deal to create a fragrance molecule from an endangered plant. Plus, they officially launched that AI discovery service, which is designed to just stuff their pipeline with more deals faster.
All right, so looking forward, management isn't just sitting back. On the earnings call, the CEO laid out what he called their 3 big bets to really hit the gas in the second half of the year.
Okay, bet number 1, the Health Pros program. Think of it like an army of doctors and trainers selling for them, a super efficient way to get customers. Bet number 2, they're jumping into the massive $13 billion electrolyte market with something called VINIA hydration, dropping in October. And bet number 3, that's the AI discovery service we just talked about. The idea is to get some really nice, high-margin cash in the door right away.
So, why are we talking about all this? The growth, the margins, these new bets? It's because every single one of these moves is pointing to one thing, one critical goal for the company.
And here it is, the roadmap they've laid out for everyone to see. In Q2, they had an adjusted EBITDA loss of $1.3 million. That's basically their operating profit, or loss in this case. For Q3, they're aiming for over $9.1 million in revenue. But the big one, the thing everyone is watching, is Q4. The goal is to hit adjusted EBITDA breakeven. If they do that, it proves their entire business model works.
And that brings us right back to the main event, doesn't it? The growth is there, it's undeniable. But the stock is kind of shrugging. The market is skeptical. So the million-dollar question is, can they actually pull it off? Can they execute and hit that break-even target by year end?
So what should we be watching for on the next earnings call?
Well, here at Talk Tickers, this is our official take on Q3 and what we think about the stock. We're projecting Q3 revenue to come in around $9.2 million, which would be a nice little beat on their own guidance. But more importantly, we're looking for that adjusted EBITDA loss to shrink, down to around $500,000. If they hit that, it's a super clear sign that they're on track for Q4 breakeven. And because of all these potential catalysts, we're giving the stock an outperform rating.
So all of this leads us to what we call our outrageous but plausible trade idea. The play is to be long the stock going into those Q4 results. Why? Because if they actually deliver on that break-even promise, everything changes. The stock could completely re-rate in the market's eyes. It would go from being a speculative story stock to a real, profitable growth company. And that, my friends, brings in a whole new wave of bigger investors. The potential upside could be massive.
And finally, we have to do this. Our standard disclaimer.
Just a reminder, this is for informational purposes only. This is not financial advice.